Good morning and welcome to today's webcast with Volati, where CEO Andreas Stenbeck and CFO Martin Aronsson will present the year-end report for 2023. After the presentation, there will be a Q&A. So if you have any questions, you can send them in via the form to the right, or if you're calling in, you can press star 9 to raise your hand and I will give you the word. And with that said, I hand over the floor to you, Andreas and Martin.
Thank you. Good to be here today and present our Q4 report and talk a bit about Volati. I'll get directly into it. And Volati, it's a growing group of well-managed companies with strong earnings. We have 6 platforms, and they're all built upon an industrial logic. We have market-leading positions and strong cash flows. And their growth potential is at least in line with Volati's overall goal of 15% per year. We have 2 natural business areas, Solis Group and Detta Group. They are both platforms. And then the remaining 4 platforms are within our business area industry. Volati as a whole, including these 6 platforms, has grown on average 32% per year since 2017. And I thought I would start by looking into our last quarter of 2023. And of course, I'm not happy to report the declining profit. We go from 179 EBITDA last year to 134 this year. But I'm confident that where we are in a good place, and I'm very proud about the work that we're doing in our platforms. And 4 out of 6 of our platforms are actually showing improved margin and an EBITDA better in line with last year. Solis still see a tough end market, and despite the declining sales for the second quarter in a row now, they come in on a EBITDA level in line or better than last year. So that shows that the measures we've taken in Solis Group are really showing effect. Aktier Group come in slightly lower on sales than we wanted. There are 2 main reasons behind that. One is that we had a very strong Q4 last year. We actually grew sales with 25% last year. And that was much because of a ramp up of demand, because there was a strike effect in the industry earlier that same year. We also see slightly lower volumes in Norway, which is something that we're addressing right now. But even though sales going down, I think the very highlight of Aktier Group is that we significantly improve the margins. We actually go from 16% to 80% in the quarter on EBITDA margin. So that shows that our model with synergies and operational improvements from the acquisitions that we do really works. In addition, we have 2 platforms in business area industry, Corventa and Tornum, that are developing very well and improving their profits in the quarter. The reason then for the decline is within 2 of the platforms. It's communication and St. Erik's, 2 of the platforms within industry. And there is actually similar reasons behind that. They both, firstly, had a very strong Q4 last year. While we have been clear with that, we see a lower demand, especially during the second half of this year in these 2 platforms. For communication, it's the 5G rollout, in particular in the US, that has been postponed. And in St. Erik's, it's the more building-related part of that business that has seen a weaker demand. Also, something that has affected St. Erik's is the cold weather. There are cost measures that's been initiated in both these platforms. We've seen some of that effect of those already in Q4, but of course we also expect more of that to show during the course of 2024. 2 more things I want to highlight about Q4. Firstly, we have done 2 value-creating add-on acquisitions, adding a total of 400 million SEK of revenue on an annual basis. And of course, it's very good to enter 2024 with that. And that will of course contribute for the full year of 2024. Lastly, we continue to show a strong cash flow, 200 million of cash flow in the quarter, and that leaves us very strong position, and not the least to act on acquisitions once they occur. Looking into the numbers, sales end up with 1.8 million compared to 1.9 billion the year before. EBITDA 134. This number is not then adjusted for the one-off costs in the quarter, compared to 180 the year before, and an operating cash flow of 300 million, more or less in line with last year. And that leaves us with a net debt to EBITDA in the lower range of our financial goal. Then going into the full year of 2023, when I summarize 2023, I'm very happy with the position that we are in our platform. We have put a lot of efforts into preparing ourselves, not only for the current market conditions, but more importantly for the years to come. And as a long-term owner, we focus on long-term structurally sound measures. And there's been a good market for doing that in 2023. And we can also see that in the one-off cost, that we have some restructuring costs in Q4 and for the full year as well, and that's the reason for that. And it's very easy when you are in this kind of environment that act very short term. It's easy to, for example, act on a cost measure related to personnel and so forth. Of course, as a responsible owner, sometimes you also need to act short term, but we are always very focused on keeping the long term in mind. So rather focusing on the long-term structural measures and making sure that we are prepared for creating long-term cash flows and profitability. Also, I would like to point out that we have deliberately acquired companies with earnings that sometimes vary over time. And one could argue that that's a contrarian approach. As most acquirers and investors, they actually look to acquire companies that have very stable profits. And they are, by definition, then willing to pay a premium for those because the competition is that very fierce. We are convinced that we get excess returns from also looking into companies that, again, has some profitability that varies over time. And we're confident that we are a good owner of those. However, since we are a diversified group consisting of 6 platforms and equally deliberately focused on acquiring companies that not vary kind of based on the same factors, in most of the cases, Volati as a whole operate close to our total average. However, in 2023, and in particularly in the second half of this year, we have had more platforms than normal that are operating below their average profitability. And what does that mean? That means that once we start getting towards our total average, that will give us a boost in the organic growth. And it also means another thing. Volati, and I tend to say this fairly often, we are best evaluated over time. Looking at the numbers then, 2023 net sales more or less in line with last year, and a growth of 3% on EBITDA. And as expected, a very strong operational cash flow. But again, more importantly, look at us over time. Since 2017, Volati, as of today, has grown an average 32% on EBITDA. And on this next slide, we're also showing the organic development. And what one could see is that roughly half of the EBITDA growth has been organically. And then, of course, the other part has been mainly driven by acquisitions. Another thing that this slide shows is that, as said, we've had a negative organic sales and EBITDA growth this year, reasons explained before. But that are then, of course, significantly below the historical averages that we have been able to show. Before leaving the word to Martin, I would like to take an even longer look at Volati's development than the 10-year development. Our overriding goal is to generate long-term value growth. And since 2013, we have grown with 18% on average. This has been done with our cash flow, own cash flow. And you who follow us very closely know that we actually divested and separately listed a significant part of Volati in 2020 and 2021. So taking that into account, I think this really showed that we have been able to create long-term value creation. With that, I leave the word to Martin.
Thank you, Andreas. So let's put some more colors on the numbers on the slides going forward here. And let's start with looking at our three financial targets and our performance in relation to them. Let's start with the first financial target, the EBITDA growth per ordinary share during the last 12 months. We are now at 3% growth versus our target of 15%, which is measured over business cycles. But so that means that we are right now below our target. But as Andreas mentioned, we are best evaluated over time. And if we look back towards 2017, the growth in our continuing operations has been 32% over per year. Our second financial target is the return on adjusted equity, which came in at 22%. So that is then exceeding our financial target of 20%. And our last financial target is our capital structure, where we came in at the net debt to EBITDA ratio of 2.0 times. And that is in the lower range of our financial target of between 2 and 3 times, which leaves us for substantial capacity for acquisitions going forward. So let's look a bit on our three business areas, starting with Solis Group. Solis Group's EBITDA came in on the same level as last year, and this is despite that they saw a sales decline of 8% in the quarter. At the same time, though, the margin in the quarter increased for the second quarter in a row. And how is this possible? Well, Solis Group has worked extensively with adapting to the market situation and with the cost control and synergy realization. So that has made them more profitable, even though it's a challenging market. If you look at the demand in the quarter, it continues to be hampered. But given the very successful work with adapting to the business to the current market situation, we believe that Solis Group is very well positioned when the volumes return. During the quarter, they signed an agreement to acquire all shares in Trejen as well. So let's go over and look at the Ettiketto Group, which saw a sales decline of 7% in the quarter. And that is mainly due to two things. The first one is that they are meeting very tough comparables from last year. Last year, we saw a pent-up demand from the aftermath of the strike at the materials supplier UPM. But secondly, also due to that we see some volume reduction in the business, especially then also, as Andreas mentioned, in Norway. But overall, EBITDA in the quarter increased with 1 million, and the margin increased with 2 percentage points in the quarter. And for full year, the margin increased even more, so it increased with 3 percentage points over the full year, which is very strong. EBITDA margin is now at 18%. Historical margins of roughly 20%. And they're doing that through successfully working with synergy realization on the acquisitions that they made, but also working with operational improvements in the normal business. And we believe that the company is now in a very good position to act on acquisition opportunities, both in the Nordics, but also in the rest of Europe. So lastly, let's look at how business area industry is performing. And they saw a sales decline of 5% in the quarter, and an EBITDA margin decline of 3 percentage points. For full year 2023, sales went up with 8%, and the EBITDA margin was flat. Business area industry is a diversified business area consisting of 4 platforms, where Corroventa performed very well in the quarter, predominantly due to that we saw quite a bit of late summer storms or late storms in Europe. and that drives the demand for water damage remediation products. Our second platform, Tornum Group, concludes a very good quarter, increasing both margins and results. And they also acquired Simeza, which is a very good acquisition for Tornum. And I think Andreas will tell a bit more about that later on. St. Eriks is experiencing a good demand in the infrastructure segment, but they continue to see a weaker demand for construction-related products. If we look at communications, we already mentioned that in the quarters previously, but they are negatively affected by the slowdown in the 5G rollout, especially in the US, and they are also at the same time meeting very tough comparables from 2022. So all in all, this concludes a tough quarter for industry, with 2 out of 4 platforms performing below what we expect in a normalized market. But as Andreas mentioned, we have taken actions to adapt to the current market, and we continue to see increasing effects from this. So with that, I leave the word to you, Andreas.
Thank you. Then we're gonna talk about acquisitions. And as you all know, acquisitions are an extremely important value driver for Volati. This slide shows the 23 acquisitions that we've done since 2020, totaling 3.3 billion of annual sales. And we are focusing on add-on acquisitions. And we can see here also that we've done add-on acquisitions in 5 out of 6 platforms. We've done 5 acquisitions last 12 months and 2 in the last quarter, Simeza and Trayon. And with that, I would like to spend 2 minutes on Simeza. It's actually a very good example of what type of add-on acquisitions that we want to do. Tornum, actually the first company that Volati acquired back in 2004. And Tornum is the European market leader within, or one of the market leaders within grain handling equipment and solutions. And what we provide with Tornum is the whole solution to the customer. But that has historically meant that we have traded the silo storage part of the offering from an external supplier. We have over time and for many years looked into actually adding that to our own offering, and by acquiring Simeza, we have now successfully done that. So that basically means that Simeza, being one of the very established European players supplying silo storage solutions, by owning that company, we could make that part of the offering to our in-house offering. And it also means that since we haven't acquired or bought these silos from Simeza in the past, the volume that Tornum delivers every year will be added to the euro 10 million of sales that Simeza reports. So we will have significant synergies. So that's it's a very good case of the types of acquisitions that we want to do within Volati. Looking on at the next slide, 16. As we have talked about earlier this year, we had a slightly lower acquisition pace in 2023 compared to the historical average. M&A work, it's binary. Either you close a transaction or you don't. And during 2023, we've had a couple of cases where we were close, but fortunately weren't able to sign to the right terms. Some of these situations will come back to us at the later stage. But for us, discipline is extremely important. I do not want the organization to get stressed up about in the short term not keeping the acquisition pace up. It's more important for us to do the right acquisitions. We are in it for the long term. But now looking at Q4, I'm very happy to see that we're actually been able then to finalize 2 acquisitions that are exactly the type of acquisitions that we do, and they meet the expectations that we have in terms of return. And of course, doing those 2 in the later part of 2023 means that we will have a very good contribution in 2024. I'm also happy with the pipeline that we have and the activity that we have in our platforms, and the fact that we are in the lower part of the range in terms of net debt to EBITDA means also that we have room for acting on acquisitions and opportunities once they occur. And the M&A market, as I see it right now, it's very suitable for a player like Volati. So to summarize, Q4 and 2023, as said, I don't think it's really reflecting our average earnings potential. We have had more platform than normal that are below what we see as their average earnings. But we have taken the opportunity to take really structurally sound measures in the platform this year, which leaves us in a very good position for long-term value creations, and the market and the circumstances for our platforms will come back. And also I'm especially happy about that we've done these two add-on acquisitions in Q4. They will have a good contribution in 2024, and we also have the financial position that will leave us for making keeping the M&A pace up once we see that we have good enough acquisitions to act on. So I think with that we leave to questions if there are any.
Thank you so much for the presentation. We got a couple of questions. I think we jump right ahead. What is the competitive landscape for Tornum Group and Semesa within the grain industry, and how does the acquisition enhance their competitive position?
The competition, as said earlier, Tornum is one of the European market leaders, and there are a few others, larger players acting on that market. I think in terms of how the acquisition of Semesa will enhance Tornum's offering is that firstly, Tornum, with the Tornum brand, we have a very strong brand, and the more products that we could bring in-house and add to that brand is a strength for our overall offering. And the real financial sense to it is, of course, that the profit that we have earlier shared with an external supplier of these silos, we now keep in-house. Semesa has been a very stable, profitable company in the past. We have acquired that profitability, but we're also able to add significant additional profitability that we have earlier than shared with an external party. That I would say is the main logic behind that acquisition.
Thanks. Can you please quantify how large the significant one-off costs in Q4 and 2023 are?
Sorry, can you quantify? Say again, please.
Yeah, of course. Can you please quantify how large the significant one-off costs in Q4 and 2023 are?
Yes. For the interested reader, you can find that in the alternative in the notes. But if we look at the 2023, there was quite a bit of restructuring costs. So for the full year 2023, that was 22 million in restructuring costs, and that is of course then related to what Andreas mentioned on that we have taken the opportunity now also to adapt the businesses to the market situation and make them well prepared for the future. So that is the predominant part of the extraordinary cost in 2023.
Thanks.
And the majority of those came in Q4.
We'll move ahead to the next question. What are the key risk factors associated with the Trejon acquisition, and how does Volati plan to mitigate these risks to ensure success of the investment?
Trejon is a very good acquisition that I hope to take the opportunity to describe in more detail at some other stage. But I would like to answer that in a more general way, but I think it's applicable to this case. I think one of the most important key success factors when you do add-on acquisitions is to really make sure that it's basically people that you acquire, people and personnel, and an organization that has been very successful in the past. And I would say that one of the main success factors is to being able to integrate those or take care of them in a good way, making them motivated to continue, doing a successful work. So I would say that that's both the key success factor and, of course, a risk then if you're not able to do that.
Yes. The communication platform came in lower than last year, and in the CEO letter, you mentioned that it's partly due to the fact that rolling out 5G in the US is not going as quickly as expected. When do you think that will take off?
Oh, if I could, I wished I would have that answer. But the reason, what has happened during 2023 is that the rollout has been very much delayed. So I'm confident that the rollout will take place, and I'm also confident that we are in a very good position to deliver once it picks up again. Whether that happens during the first half of this year or second half of this year or even beginning of 2025, I don't know. I don't have the answer to that. What I know is that we are working under the circumstances that we will have this type of environment now for some time, and we have adjusted our operations to that.
Thanks. The organic growth in Q4 is negative. What will you do to increase sales in the coming quarters?
We always work very actively on increasing sales. I think a few comments to that. One is, yes, we have a negative organic growth, but I'm also fairly confident that we are not losing market share. I think we're rather gaining market share in many of our platforms. So this organic development, it's mainly driven by external factors. And what typically happens is, markets come back, demand comes back, unless there are structural problems in an industry, which we do not foresee in the industries that we're working within. Demand will come back. And I think what I'm trying to put some emphasis on is that we're in an extremely good position now to act on, act on the sales opportunities once the market come back. And then we will also see the benefits of an organic sales growth again.
Thanks. You have stronger margins in 4 out of 6 platforms in Q4. Still, EBITDA declined by 25% in Q4. What were the main drivers and how do you counter this going forward?
I think the answer to that is fairly easy. It's 2 our platforms, and I tried to address that earlier in this presentation. It's St. Eriks and Communication. Firstly, they had a good quarter last year, so they met the tough comparables. But we're also seeing a lower demand in parts of their businesses. So the reason lies within these 2 platforms, and the measures are already addressed. We have that undergoing, and we will see those effects during the course of 2024.
Thanks. During 2023, the value of many companies fell on the markets. Do you see an opportunity to find bargains on the acquisition market?
Sorry, we lost you. I didn't hear that full question.
Yeah, I will repeat. During 2023, a lot of valuation for many companies came down a bit. Do you see an opportunity to find bargains on the acquisition market?
I wouldn't call it bargains. It's most of the cases you have a very sellers that decide to sell. But of course, as valuations come down, and they have come down somewhat, and we are in a position, a financial position to acquire, and we're also active in industries which we very comfortable with and have a lot of good knowledge about. So I think we are in a good acquiring position. So all in all, that leaves us in a good place. We will most likely be able to do some good acquisitions in the coming years.
Thank you. Moving on to the last question here. What is your it's sort of the same question earlier a bit. What is your assessment of the acquisition market going into 2024?
The assessment is that we've seen it's been constantly picking up, I would say, in terms of activity, the M&A market for the last 12 months or so. I expect it to continue picking up, being a bit more active. The main reason for that is that we've had a valuation gap. We've seen that, we've experienced that as acquirers, that we're not really able to meet some of the sellers. That gap is now closing. I think the sellers has adjusted their maybe valuation expectations a bit downwards, while most buyers might, we will maybe will be a bit more confident about valuing the businesses as well. So once you have buyers and sellers meeting, activity will pick up. And I think for 2024, the circumstances for that will be better in 2023. So I'm confident with where we are.
Thanks. Actually, we received another question here. How big share of revenue has St. Eriks to building related products?
I don't think that's unfortunately something that we share publicly. But it's a very relevant question, because we also have the St. Eriks addressing the infrastructure segment, which is very stable and where we actually see a stable or good demand. And where we see a weakened demand is in the building related parts. But we do not provide that split, unfortunately.
Thanks. That was all the questions I have. So I wonder, do you have any concluding remarks here, Andreas?
Yes, just summarizing from my perspective. Yes, we reported declining profits in Q4, but that is something that we are aware of can happen with the type of fantastic platforms that we have. I'm very confident in the position that we are right now. We mentioned that we're taking the structural long-term measures during 2023, preparing us very well for the times to come. We already now see that 4 out of 6 platforms are improving their profits, so the measures are working. And but still, we are right now in a place where more platforms than normal are operating under their average profitability. And once that change, we will get the boost in our organic growth. And finally, I would just, there have been a lot of comments and questions about M&A. There always are when it comes to Volati, but I'm very happy with the 2 acquisitions that we did in Q4. That will give us, of course, some help to fuel growth in 2024. And I also feel that we're in a good place to continue doing acquisitions. We have the financial capacity and we have the processes in place. So 2024 is a year that I'm really looking forward to, together with all my colleagues of Volati.
Thank you so much for the presentation today and asking all questions, and thank you all for tuning in. Have a nice day.
Thank you. Bye.